I want to welcome you to the second video cast for investments. On this one, we're going to cover discounts and the straight line method of amortization. And what would have with a little bit of difference, this is the same information with the exception the stated rate is now 8% and the market rate is 9%. And when that happens, anytime the market rate's greater than the stated rate, you know it's going to be a discount. But we go through the same thing we did before. We first have to find the present value of the bond. So that's 150,000 times. Okay, we go to the present value tables. Now in this case, we want to use 9%, so we use 4.5, because remember, divide it by 2 because it's semi-annual, and 20 pay periods because it's how many pay periods you have. And if you do that, you see it's 0.414643. And if you multiply that out, it gives you 62,196.45. Then we have to do the same thing, except we find the present value of the interest payment. So the first thing you do is find out how much interest you're going to receive every 6 months. That's at the 0.08 divided by 2. And if you multiply this out, that gives you the 6,000. Now we need to go to the present value of an annuity. Again, it's 4.5% at 20 pay periods, and that'll give you the 13.007936. If you multiply that out, it should give you $78,047.62. Add those two totals together, gives you 140,244.07. Okay, that's the amount you're going to be willing to pay for the bond. So this is sold at a discount because it's less than face value. And this is strictly based on market conditions. You're saying, okay, they printed the bonds up at 8%. They can't change the the stated rate on the bonds without going through the state. So they're saying, okay, what we'll do then, if the market rate says you have to have 9%, which is what the investors say, then we'll sell you at less than face value, and that's why they do that. Okay, so that's the 140,244. The amount unamortized discount is the face value minus what you paid for it, 97.55.93. Over here, we want to do the interest calculation, which is the 150 F4 times 8% absolute value divided by 2, comma 2, close, $6,000. And over here then, equal round, take the carrying value, don't absolute value that one, times, this is the market rate divided by 2 because it's semi-annual, and here's where I messed up last. Don't forget to absolute value the market rate, comma 2, and close. So that gives you 63.1098. The difference between the two is the amount to be amortized. Again, you always want that to be a positive number. So take the largest minus the smallest one, or you take the absolute value of it. And this is going to be the unamortized discount minus the amount you amortize. The carrying value is going to be a little different. It's going to be the carrying value from plus the amount you amortize. Okay. The other way you could do this is also take the 150,000 here and subtract the unamortized discount. Will give you the same results. And then you just copy that down, and that is because when we get done with it, remember that should be 150,000. I'm not doing all 20 pay periods, just 3 of them. Okay. This is your initial investment. So it's the 142.4407. Okay, so you debit the investment in held to maturity securities and credit cash. And now 630 is your first amount, the interest that you received. Well, the cash you received is the 6,000. You want to increase the investment account by the amount you're amortizing. Now this is the effective interest method, and this is the total. Okay, you can use the effective interest method. That's what FASB actually prefers, but there's another method that we're going to get into a little bit later. The second period, you still received the 6,000. $324.98 is the, and that's for the interest revenue. In the third period, you should still receive the $6,000, $339.60, and interest earned is $63.39.60. Okay, and you need to continue on. You'd have this done for 20 pay periods, which I'm not doing all 20 pay periods, but that gives you the idea how this works. It's after you notice you have to get the first line done, the 630. All you do is just drag it down. It should calculate itself. When you get done, however, this amount here should be 0, and this one should be 150,000. The last one you may have to adjust a little bit because of rounding. Okay. Now, the straight line method. I'm going to do the same example. So this is still going to be 150 minus. Okay, so that hasn't changed any. I'll get this up here so you can see it. Okay. The interest received is going to be the same. Round 150 F4 times 8%, F4 divided by 2, comma, to the $6,000. Okay, that hasn't changed any. Now, for the discount, though, on the straight line method, this is done a little differently. We have equal, take the unamortized discount. I'm going to do a round function because I'm doing Excel. Okay, the unamortized discount divided by, I'm going to just put 20 in there, comma 2. The reason why it's 20 is because it's 10 years semi-annually. So we have 20 pay periods. Okay, so we're going to take $487.80. Now, because this is a discount, we would take the $6,000 plus the $47.80. If this was a premium, it would be subtracted, because remember, premiums reduces the amount of interest revenue you record. And this column is done the same way. 97.55.93 minus the 47.80. And this one is also done the same way. 140 plus the amount that you amortized. Okay, so when you get done with it, you just do this down here, add it together. Okay. This straight line method is acceptable by FASB if it doesn't materially differ than the effective interest method. Okay, and that's a judgment call. But the entries are done the same way. 140. Okay, this is the amount you actually paid for it. This is what it was worth. Cash. Okay, we still received the $6,000. The difference is that this is going to be $487.80, and this is going to be the same entry all the way down. There. Okay, and then this is going to be the 6,000. Oops. Let me rephrase that. I forgot to do something. F4. There we go. That's better. Okay. This should be the 47.80 all the way down. Forgot the absolute value again. Okay. So it's going to be the same all the way through. Equal, this is the 6,000. Equal 487.80. Equal, okay. So this is how you do the straight line method. The discount amortizes the same, that's why it's a straight line. Just divide it by 20 or the number of pay periods that you have, and then for the interest revenue, it's going to be the two added together for a discount. Remember what I said, if it's a premium, it will be subtracted. So this is the effective interest method for the discount and for the straight line. Okay, I'll cover this next time. All right, that should be it, and hopefully that helps.